In this episode, we're going to talk about why some companies pay dividends and why some do not. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 5 topics. First, we're going to look at what are dividends. Then we'll look at reasons why some companies do not pay dividends. And then we'll look at reasons why companies do pay dividends. Then we'll look at the benefits of receiving dividends. And finally, I'm going to give you 2 real-life examples of investing in dividend companies, and we'll take a look at the sample returns. Let's get started with our topic number 1. What are dividends? So if you look on the screen here, you'll see that Apple has a little over 15 billion shares outstanding. If you were to buy all of the shares, you would technically own the entire company. But if you buy just a single share, maybe 5 shares or even 10 shares, you are still considered part owner of the company. And as part owner of the company, you're entitled to share in the benefits and the profits of that company. And so those profits come to you in the form of, we call them dividends. So in this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend of $1 per share. Now, the stock price can go up and down. We're going to take a look at it later in this episode. Stock prices can go up and down all the time, but as long as the dividend is being paid out, you will earn those dividends based on the number of shares you have. Now, you can spend those dividends if you wish, or you can reinvest them into other stocks that pay dividends. Now, the dividend is automatically deposited into your trading account as cash. Now, you might have some dividend misconceptions, or you may have heard of misconceptions about, companies cutting dividends or companies that, reduce the dividend or the fact that there's no guarantee of dividends. So I cover all of that in episode 57. If you haven't watched it, I recommend you go back and watch episode 57, and we cover a lot of misconceptions around dividends. Now let's continue with our dividends. So a company's earnings are its after-tax net income or profits. And that's where the company gets its money to pay the dividends to you, the shareholder. So it's coming from those profits. Now companies can choose to pay a dividend or not. There's no guarantee. There's no legal obligation to pay a dividend. So it's entirely up to companies themselves. So now let's take a look first at the reasons why a company may not pay dividends to the shareholders. Now, companies can choose not to pay the dividend for several strategic, financial, or operational reasons. So we're going to look at some of the major reasons here. So reason number 1, reinvesting profits for growth. So a company believes that it can earn a higher return by reinvesting those profits into the business. For example, creating new products and services, acquisitions, or expansion. So if you take a look at tech companies like Amazon or Tesla, they retain their earnings to fuel rapid growth. And as of this recording, Amazon and Tesla do not pay any dividends. Another reason is the company may want to maintain financial flexibility. So retaining earnings provides a financial cushion for tough times or unexpected opportunities. So this way, the company doesn't have to take on additional debt. They keep all the profits for themselves, reinvest it back into the business, or you're not diluting by issuing new shares, right? So that's another way for a company to generate more money or to take on more debt. So if they don't want to do either of those 2 things, then they might be better off just holding on to their earnings instead of giving them away to the shareholders. Another reason is some companies are in a growth phase or an R&D phase, right? So a lot of younger tech-heavy companies often have very high capital expenditure needs. So dividends may come later once a company matures. And a couple of examples like that are Apple, right? When the company first started, they did not pay a dividend for many, many years. Same with Microsoft, same with Cisco, same with Google. But all four of these companies are now paying dividends to their shareholders. Another reason could be if a company has inconsistent or unpredictable earnings. So that's a problem, especially if you're giving out dividends, because dividends are given out regularly. Usually it's every quarter, and the company wants to pay that dividend to the shareholders. So companies with volatile cash flows, they don't want to commit to paying regular dividends, right? And then having to cut them later, because that is interpreted negatively in the stock market. So when a company reduces its dividend or gets rid of it altogether, you'll see majority of the time the stock price is going to drop, because the stock market investors believe that there's now something wrong going on with the company. It's not able to pay its shareholders. So are the earnings dropping? Are the profits going down? What's happening? So for companies that have unpredictable earnings, they go up and down every year. They have negative earnings, then it goes up again, down. They are not in a good position to be paying out dividends. Another reason could be tax efficiency. So in some places, dividends are taxed at a higher rate than capital gains. So if that's the case, companies may retain those earnings to boost the share price, so benefiting shareholders that way via capital appreciation, because then if the stock price goes up, you can sell it for higher, you can get some capital gains that way. And the next reason is high debt levels. So a company that has significant debt may prioritize paying down the debt instead of taking that money and giving it to shareholders as a dividend, right? So that makes sense as well, because the more debt you have, if the interest rates go up, now you're going to be paying even more to service that debt. So if you're in that situation as a company and you've got earnings and you're sitting on that cash, might be better off to pay off your debt as opposed to paying the shareholders. And our last reason here is management philosophy, right? So some leadership teams believe that shareholders are better off reinvesting those gains themselves rather than receiving dividends. Perfect example of this is Warren Buffett's Berkshire Hathaway, which has never paid a dividend, and they prefer to reinvest their earnings back into the business to grow the business. So it's not either or. You don't have to take all of your earnings and all of your profits and give it to the shareholders, right? Some companies, they can do both. They can have some retained earnings, and then the rest of the earnings they can pay as a dividend to the shareholders. So let's take a look at that. We're now going to look at why companies pay dividends. So there's a couple of reasons here, right? It's for strategic reasons, financial reasons that they want to pay them. So let's take a look at some of the major reasons here. Number one is to reward the shareholder for owning the company. So dividends are a direct way for the company to reward shareholders for their investment. And this is great for dividend investors like us, income-focused investors, because we're looking to make money on our investment while we hold on to it. And great for long-term holders as well that are looking for steady returns, beyond the share price, because the share price can go up and down anytime. But a dividend is consistent, and so that is great for shareholders like us. And so it's a way for the company to reward shareholders and kind of build some loyalty, where investors like us, we're not going to buy and sell the stock multiple times in a day, in a week, or a month. We're not day traders. We're not doing that. We're long-term investors. And if a company is paying a dividend and increasing the dividend every year, that makes it worthwhile for us to hold on to those shares. And number two, it's also a sign of financial strength, right? Paying a regular dividend signals to us that a company has consistent earnings, strong cash flow, and the company itself is confident in its future profitability, right? We have companies that we look at, for example, Coca-Cola, Johnson & Johnson, they have been paying dividends for over 100 years, but more importantly, they have been consistently increasing their dividends every single year for more than 55, 60 years consistently. So that gives us confidence that this is a company that will continue to pay us a dividend in the future and continue to grow that dividend. So it builds investor trust, and again, it can attract more stable, long-term shareholders in that company. Another reason, number 3, is capital allocation discipline. If a company has more cash than it can profitably reinvest in growth, then returning that profit or the earnings to the shareholders can be a smart, disciplined choice. And it helps the company to avoid wasteful spending or risky acquisitions, right? If they're sitting on a pile of cash and they don't know what to do with it, it's just human nature. You may start making some risky acquisitions or start spending it on goods and services that your customers don't need. So, there's opportunities here for a lack of discipline. But if you take that money, those extra earnings and profits, and you're giving it back to the shareholders, that is a form of discipline from the company's leadership. Reason number 4, some investors, especially institutions like pension funds, prefer or require dividend-paying stocks. So meeting that demand can boost the company's stock price and reduce volatility by attracting, again, long-term, stable investors, right? So we're not day trading. The stock price isn't volatile up and down constantly, and it's stable and great for long-term investors like ourselves. Reason number 5, in certain markets, dividends receive favorable tax treatment, making them more attractive than capital gains. And if that is true where you live, then you are better off earning dividends versus capital gains. You can still do both, but in some places you will pay less tax on the dividends than you would on capital gains. And lastly, reason number 6, initiating or increasing dividends can signal confidence in future earnings, right? So when a company announces a dividend increase, we know as investors, okay, the company's confident they're going to be able to pay that higher dividend in future years, in future quarters, right? And if you look at somebody like Johnson & Johnson that I mentioned before, or Coca-Cola, 57, 58 years or more of consecutive dividend increases, when they announce a dividend increase, you can be sure that they've looked at their numbers, they've looked at their books, and they're forecasting, and they feel confident that they can pay a higher dividend to the shareholders. So that kind of dividend policy of growing the dividend consistently is a sign of confidence for investors like us, right? So and it's good for the stock price as well, because every time a company increases the dividend, over time you'll see that it raises the stock price. So now, what are some of the benefits to you as a dividend investor, right, for receiving dividends? Well, the biggest one is going to be you want to get paid for owning stocks, right? Without the dividend, you're just holding on to the shares, hoping that the stock price is going to keep going up and hoping that it's going to go up when you decide to sell those shares. But for us as dividend investors, this is the biggest thing. The biggest benefit here is we want to get paid for owning stocks. And so why is that? Why don't we just wait for capital gains? Well, let me give you a quick example here. If you take a look at Microsoft from the year 2002 to 2013, that's an 11-year period. And you can see it up on the screen. You can see the stock price chart for those 11 years. You'll notice that the stock price has not gone anywhere. Now, specifically, in 2002, the stock price was $28 a share. In 2013, it was still $28 a share. So the stock price return was 0. So for 11 years, if you owned Microsoft during that period, your stock price return was 0%. You didn't make any money, you didn't lose any money, but it was zero, right? You would have been better off keeping that money in a checking account or a savings account, right? However, let's take a look at the dividend during the same period for Microsoft. So you can see here up on the screen, I'm not going to read out all the numbers because it's 11 years worth of dividends. In 2003, the dividend was 8 cents a share. In 2013, it was 89 cents a share. And you can see that they grew the dividend every single year for those 11 years. So now if we calculate the return, including dividends, during that 11-year period for Microsoft, that's an 18% return. A lot better than a 0% return if you were relying just on the stock price. Now, there is a happy ending, of course. The dividend today, as of this recording, is even much higher. It's $3.32 a share. And the stock price now has gone up, like considerably. As of this recording, $472 a share. So dividends provide you a return while you wait or hold on to your shares. It's a margin of safety against stock price drops. So even if the stock price drops over a 2, 3, 4, 5-year period, but you've been receiving dividends, and the dividends, you're collecting them and they're hopefully increasing the dividend every year, then that's your margin of safety. And like I said before, increasing dividends over the long term help to raise the stock price. So without dividends, you need to keep hoping for stock prices to keep rising. But hope is not going to cover your living expenses. Only dividends can do that. So use dividends to your advantage. So avoid the temptation to spend your dividends, right? If you have a day job, use that to cover your living expenses. If you don't need to eat into the dividends just yet because you're still working, you're young, avoid the temptation to spend that money. Take those dividends and reinvest them. That's how you're going to compound your growth. Reinvest them into other stocks that pay dividends, and then take those dividends and reinvest them into other stocks that pay dividends, right? So you take advantage, and you take advantage of the dividend growth. And the companies that we look at continue to increase their dividends year after year. And you can also stay ahead of inflation. If you haven't watched it, I highly recommend you go back and watch episode 11. We cover inflation and how you can beat inflation with our dividend investing approach. Okay, let's get on to our final topic in this episode. I'm going to share with you 2 real-life examples of some sample returns of how much money you could make with dividends. So we're going to take a look at 2 companies here, Reliance and Lilly. Reliance trades on the New York Stock Exchange as RS, that's the stock symbol. The company was founded in 1939. They have a little over 15,000 employees, and the company, as of this recording, is worth $16.4 billion. It is a diversified metal solutions provider and metal service center, primarily in the US and in Canada. So it distributes metal products and metal processing services. Our next company up is going to be Lilly, also trades on the New York Stock Exchange. The stock symbol is LLY. This company was founded in 1876. They have 47,000 employees and a much larger company. You can see here the market cap. The company is worth over $721 billion. And you can see here under the description, Eli Lilly and Company. It's a pharmaceutical company, and they manufacture pharmaceutical drugs. So let's take a look at Reliance first. We're going to take a look at the 10-year dividend history. So we're going to go back to 2015, and you can see up on the screen, the dividend back then was $1.60 per share. And then we continue. I'm not going to read out all the numbers up on the screen here. As of this recording, we're still in 2025. The year hasn't ended yet, so technically it's about 9.5-year dividend history. We're not at the 10-year mark just yet. But as of this recording, the dividend today is $4.80 per share. And you can see it up on the screen. The dividend has gone up every single year consecutively for 10 years in this example. Now, what about the stock price? Let's take a look at the Reliance stock price in the last 10 years. And you can see the stock price chart on your screen. And you can see, like I said, stock prices go up and down all the time. And you can see places where the stock price drops by $5 a share, $10 a share, $20 a share drop in the stock price. But yet, the dividend continues to go up during that same period every single year. So how can the company continue to pay a higher dividend when its stock price is dropping? And the reason is, like I said earlier in this episode, the dividend is not paid from the stock price. The dividend is paid from the earnings, from its profits. So as long as the company over the long term is profitable, they can continue to pay a dividend and grow their dividend. Let's move on to our next company, Lilly. We're going to take a look at the 10-year history. Again, going back to 2015, you can see that the dividend per share back then was $2. Today, as of this recording, the dividend per share is $6. So that's a significant increase over the last 10 years. And remember, every time the company increases its dividend, that's more money in your pocket. So now we're going to take a look at an hypothetical situation. We're going to assume we have $10,000 invested in each of these two companies, in Reliance and in Lilly. And we invested that back in 2015. So over 10 years, what was the performance? How much money did you make? Did you lose money? Did you make money? So we're going to take a look at that right now. So we'll start off with Reliance. $10,000 invested back in 2015. Since then, you would have received almost $6,000 in dividends, which is pretty good. You invested $10,000 and you've received over almost $6,000 in dividends. The value of that investment today, including the dividends, would be worth over $65,000. Let's take a look at our next company, Lilly. Again, $10,000 invested in 2015. You would have received over $5,400 in dividends. The value today, including the stock price appreciation, plus the dividends received over those 10 years, or 9.5 years, as of this recording, the investment in Lilly would be worth over $122,000. Now remember, you invested $10,000, and now it would be worth over $122,000. So if we add up all the numbers, you can see in 2015, our total investment was $10,000 each. So that's $20,000 total across the two companies. You would have received from those two companies, just those two companies alone, over $11,000 in dividends. And your investment today would be worth over $188,000. So that is really good. That's a great return of over 842%. That is an 842% return just within 10 years, technically 9.5 years, right? And that's an 842% return just with these two dividend paying companies. If anybody's interested, I highly recommend you go back and watch episode 7, where I cover lots more examples of dividend paying companies, and we take a look at some extraordinary returns over many years, over the long term. So go ahead and watch episode number 7 to take a look at that. So our approach to investing, and you can probably tell by now, is to focus on dividends. And so what we do is we invest in quality dividend paying companies when they are priced low. So not just at any price, you want to make sure that the stock is undervalued, not overvalued, undervalued, and it's got to be a quality stock. Can't be any stock that pays a dividend. Has to be a quality stock. So how do you know when you're looking at any stock anywhere in the world if it's a quality stock And how do you know if it's priced low? That's the big question here. And the answer is we use the 12 rules of simply investing. And you can use those rules as well. The investing rules are designed to lower your risk, save you time, and help you earn more consistently, year after year, regardless of what happens in the stock market. So you can see the 12 rules up on the screen here. I'm going to go through them fairly quickly. And the way it works is a company has to pass all of the 12 rules, not just one or two, all of them before you invest in it. If a company fails even one rule, skip it, move on to something else. So rule number 1, do you understand how the company is making money? If you don't, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? Rule number 5, is the company profitable? Rule number 6, does it grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid companies with recent dividend cuts. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? So we look at 3 things in rule number 11. We're going to take a look at the current dividend yield compared to the average 20-year dividend yield. We're going to look at the PE ratio, and we're going to look at the PB ratio. And if the company passes those 3 conditions, then it passes rule number 11. And finally, rule number 12, keep your emotions out of investing. So we have an all-in-one solution. It encompasses the Simply Investing web application and the Simply Investing dividend course. The application, it's a web app. You log into it. It applies the Simply Investing criteria to over 6,000 companies in the US and in Canada every single day. And it immediately tells you which companies pass the Simply Investing rules, which ones fail the Simply Investing rules, so you can avoid them. And the ones that pass, we narrow that list down to just a handful of companies, and the application makes it really easy to sort through that and to look at that. And you don't have to spend hours and hours and hours a week researching companies. The application does that for you. We also allow you to keep track of companies you're interested in. You can plan your dividend investments. We have a dividend simulator in there, so you can simulate what your investments would grow into, and you can track your investments in our application and get important things like dividend yield on cost and see your diversification as well. And included in all of this, in the all-in-one solution, is the Simply Investing course. It's a self-paced online course. There's 10 modules. In module 1, we go over the investing basics. In module 2, we go over the 12 rules of Simply Investing in detail. Module 3, you learn how to apply the 12 rules yourself to any company anywhere in the world. Module 4, you learn how to use the Simply Investing web application. Module 5, we show you how to place your first stock order. Module 6, building and tracking your portfolio. Module 7, learning when to sell, which is just as important as to know when to buy. Module 8, how to reduce your fees and risk, especially if you own mutual funds, index funds, and ETFs. Module 9, we give you your action plan to get started right away. And Module 10, I answer your most frequently asked questions. If you're interested, you may want to write this down. We have a coupon code, SAVE10, SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution, so you get access to the course and our application as well. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well, and for more information, take a look at our website, simplyinvesting.com. Thanks for watching.